This is the OnePoint Podcast. I'm Rohit Yadav. Welcome to this new streamlined format that is shorter, sharper, and more impactful. In each edition, I'll spotlight either an insightful trend from the ecosystem or a thought provoking perspective from a venture expert or a bold idea worth exploring further. Okay. And today I have Andrew Endicott with me, whose posts on employee equity were quite intriguing for me to invite him for the discussion. Andrew is a financial technology entrepreneur and a venture capital investor. He's the founding partner of Gilgamesh Ventures, which is a global early stage fintech focused venture capital firm based in the New York. And prior to Gilgamesh, Andrew co-founded Petal, a financial technology company in the credit card space in the US. And he was also an investment banker at Lizard and a corporate lawyer. So let's dive right into it. Andrew, what is, first of all, Gilgamesh?
Yeah, Gilgamesh Ventures. I started it with my good friend Miguel Armaza about 5 years ago. He and I come from different parts of the world of fintech. And investing in fintech is what we do. We search for leaders that have the horsepower to create companies that will revolutionize how finance and how financial services work. And a lot of what we do is really a reflection of our DNA as people. As for myself, like you said, I spent the better part of the last decade as an entrepreneur. Myself, I started a company called Petal in the credit card space and experienced the whole range of ups and downs and challenges and successes and failures of starting a company. And after doing that, I didn't have the desire to start another company. But I wanted to be around people starting companies. And so, fintech is what I know very well. And the same thing is true for my partner, Miguel, although a little bit differently, his angle of things. But so we invest globally. We invest at an early stage. So typically seed stage companies or pre-seed companies, seed-ish companies, typically. Which is where we feel we can have the biggest impact as investors. And some of that investing is in the US, a lot of it is non-US, but it's all fintech, that's the place where we have competence, where we have expertise, which is where we like to focus our attention. That's what Gilgamesh is and does. It goes without saying, we love to meet great people who have bold ideas and starting ambitious companies.
So, Andrew, I just have one follow-up question. What part of the portfolio is in the US and what part is like outside the US?
Yeah, so it's about 50-50 today. And it changes from time to time. So we've been running the fund for 4 or 5 years. And so we have companies that have been around for 3 or 4 or 5 years. So some of them, becoming somewhat more mature, and a lot of the we're in our second fund today. And so, a lot of the portfolio is still, quite young companies, pre-seed companies that we recently invested in. So a lot of them are going to be stealth or companies that you wouldn't know about. But in the United States, we've got a number of investments that are kind of gaining some prominence, Base Layer, Affinity, Modern Life, Boom, and others, kind of running the gamut of financial technology, business models, and approaches. And then outside the US, we have a really good mix of companies: Zeppelin in Mexico, Cayena in Brazil, Nexu in Mexico. And we've made a lot of our portfolio has ended up being in Latin America, where we have particularly strong connections. So those are some of the names that may be familiar, some of the more mature businesses. But we invest in, like I said, early stage across all types of fintech. In addition to some things that may not be immediately obvious to be fintech to other people, we also invest in.
Okay, I think it pays to be in fintech right now. It's a hot market. There are a lot of companies which are going public. So there's a momentum building up in fintech, which we didn't see for the last couple of years, but it's sort of coming back. Either it's from the original fintech, or you might call it as crypto focused areas, which I wouldn't call it pure fintech, but still related to finance and so on. So let's jump into the main section. And the reason we are sitting today in this podcast is your post on employee equity. And you have written that the early stage employee equity model is sort of unfair and needs to change. So, what do you see as the single biggest flaw in the current system?
Yeah, I think there's several flaws. And I also think that just as we get into this, I think giving employees the opportunity to benefit from the success of their companies is a glorious thing. In the United States, it's been a driver of a lot of economic mobility. And it's kind of fair, right? Like that as a company does very well, you do very well too. That there's that's part of it. But there's several flaws in the current system. But to me, there's one major flaw that drives a lot of the issues, and that's a tax regulation in the United States. Each country is going to be somewhat different when it comes to equity compensation. I'm most familiar with the U.S., having been an entrepreneur and also an investor, but I'm somewhat familiar with other models because we invest in some of them too. But the United States, which kind of sets the model, I think, for a lot of the world. It's kind of the largest venture market. The IRS has a couple rules that have some major implications for how you organize equity compensation. The biggest one being the 409A rules, which make it such that if you're going to give an employee equity in a company, it is heavily encouraged to set that as an option, a stock option, and to set the strike price of that stock option to be equal to the fair value of the company at the time that it was granted. That itself creates several issues. The first is that you're giving an employee an option, which is not the same as giving the employee equity, and they have to then buy the equity at the strike price. There's another issue that the strike price is equal to the fair value of the company, and so in a sense, you're giving the employee something that doesn't really inherently have value. You're giving them the opportunity to buy something for what it's worth, which, theoretically anyone could do. Anyone, you could, if you wanted to invest in the company, you potentially just could at the fair value. So the compensation that the employee is getting is in some ways not real compensation. It's an opportunity to buy something at the fair valuation. And then there's other kind of knockoff effects of all of this that are problematic. I think one of the biggest ones is the way that equity typically works, the way that options typically work in the US, and there's some variability around this, is that employees only exercise those options after they leave a company. And because you're continuing to vest, you're earning more of that equity over time as you're at the company. But when you leave, you typically have something like 90 days, sometimes 30 days. It depends. You have a short period of time to come up with a very significant amount of money in some instances, and often with very little information. Typically, company financials and performance are shared most at the board level. They're
Hmm.
not really shared with everybody at the company, particularly a lot of the detailed information. You'll have very superficial sharing of financial information. And so the employees that have these options are then having to make a decision very quickly for a significant amount of money, significant to their net worth, and they're not able to do it while armed with good quality information, the type of information you would ever use to buy a public security, where you have, audited financials and you have all this regularly updated information with all these standards that, like you would if you were to invest in the S&P 500. You know exactly what you're putting your money into. So that's a couple different things that are problems. And there's another issue that I have with all of this in the background, that people leave good jobs often to join startups, often with equity compensation being one of the main reasons they do it. And so often people are foregoing a higher cash salary somewhere else to work at a startup for the equity compensation because they see that as tremendous upside. Yet, there are all these problems with that equity compensation that it's not set up in a way that's ideal for that employee. And it's also not, when that person is accepting that job, most of the time they don't understand any of the things that we're talking about. And that's kind of the meta problem, is that it's so complicated that you wouldn't realistically expect most people to really get it. Yet that's the system we have. Everybody, or most people who join startups, end up, kind of accepting a job on, you know, the understanding that their equity is worth something, which in all likelihood that probably is not correct. What was communicated to them is probably biased and flawed in various ways, and they don't understand that they're going to have to come up with money. They're not going to have much time to do it, and that they're not going to be able to do it with good information. So
Okay.
I think that I think that this system probably should change in in the future. I don't know that it will, because it's kind of an ingrained system, and there are good reasons why it's designed in a lot of ways as it is. But there are alternative approaches to how it functions, and so it's. I'd love it if more people pay more attention to the issue.
Okay. So three things you mentioned, three core things. One is the tax implication or the tax area, which is specifically focused on the US because that's the area where you have more knowledge on. So tax is the biggest, how it's treated and so on, how options are treated. Second, you focused on most of them are exercised while the employee leaves, after the employee leaves, and it's a significant amount of capital that needs to be
Yeah.
produced by the
Yep.
employee. And the third is the communication or the understanding around this whole topic, and also the understanding around that they're leaving a company. An employee which joins a startup has to leave a maybe much higher paying salary somewhere, and options aren't like equivalent in terms of that high salary, right? It's not cash, it's still options. Okay. So let's capture one by one each of them. You talked about communication, or rather miscommunication. Where is it coming from? Is it coming from the startup founders who are not telling the employees on purpose, maybe, or not on purpose? Or is it the onus of an employee to understand these topics better? So, what's the real problem around miscommunication, and how you can propose to make it better?
Yeah, I think it comes from a lot of things. The probably most a lack of sophistication on the part of everyone. So I think the even when you're talking about a founder of a company, that most founders of companies are not experts in even the capitalization of a company. When founders go out to raise money, they're actually learning for the first time how preferred stock works, how common stock works, how options work, the rules for all these things. Even years into running a company, often many times founders won't understand these issues very well, and they won't understand. They'll understand their equity much better than they'll understand the individual employees. So that's part of it. I think a lot of times the nobody around the table really gets it. The investors understand it better than the other two groups. And so, the if investors were explaining it to employees, they would probably do a slightly better job, because they just kind of deal with this every day. It's the only thing that investors really do, is deal with capitalization of companies. So sophistication is the first part. The second thing is, I think startups are just imbued with a tremendous amount of optimism, and a lot of positive energy. And so founders have extraordinary confidence in what they're doing. They have to. It's part of the job. They believe that they're going to change the world. They believe that they're creating a $1 billion-trillion company, whatever you want to use for it. The employees that are joining a startup, they're probably doing it because they see the promise. They're stepping away from a job which maybe is boring and slow growth and stodgy, and they're joining this rocket ship that's going to do all these crazy things. And so they believe in it too. Typically, I think that is generally true, that the employees are excited about it. And so what happens is you have a very optimistic person presenting the value of this equity, and then you have an optimistic person evaluating the value of that equity. That optimistic person is generally not worried about something like, the pref stack that a company has, which I don't know. I don't know if your listeners know exactly what I mean by that, but preferred stock gets paid before common stock. And as you raise more money, if you've raised $150 million and you sell a company for $100 million, the preferred shares get all of the money. The common shares would never get any of the money. Common shares is all that the employees ever get. They don't get preferred stock. The investors have preferred stock. And so that optimism infects the way that that's communicated. Typically, employees never learn anything about preferred shares or the pref stack or any of these things. It's completely obscured. So you have an optimistic person presenting this. Typically, when founders are kind of showing a new employee kind of their their offer, their equity package, they're talking to the employee what it's worth, kind of based on their opinion of what the company is worth, not necessarily what the market believes the company is worth, because they're selling. They're trying to hire this person. They've chosen they want to hire this person, and they're doing everything they can to get them on board. And so, naturally, I think some exaggeration, whether intentional or unintentional, creeps into that. And then the employees themselves, like I said, they kind of they either don't understand it. Most of them probably don't, except for executives joining the company, and oftentimes they don't even really understand it. And so they're not sophisticated, and they also want to believe it because they're joining this company in the first place
Okay.
and taking this risk.
Any solution that you would recommend? So, just for this communication part, because I would assume, I mean, there are obviously articles on this topic and so on, which any employee can easily read. So, what would be the highest solution, or the biggest solution, or the low hanging fruit solution from your side to solve just for this miscommunication or misrepresentation part?
Yeah, and I really I don't think it's misrepresentation sounds like it's intentional. I think most of the time this good intentions lead to these problems. I think the biggest thing that can be done, because the hazards of this primarily fall on the employee who didn't understand it or accepted a deal they don't understand, really comes down to understanding how it works, first of all. So, like, reading those articles and listening, I guess, to us talk about this. But, so understanding the system very well, from start to finish, joining a company, leaving a company, exercising options, selling the stock, which is a whole other issue. Liquidity for employees is often, very difficult to obtain and very far in the future. So knowledge and understanding is the first order of business. And then I think being really firm about getting the information. I think, just communicating before you accept an offer to work somewhere that you want to know exactly how many shares outstanding there are. You want to know exactly what the preferred stack is. You want to know what the 409A price is. You want to know what the price per share of the last funding round was, and you want to know the restrictions on the ability to sell your shares if you eventually exercise your options. And you also need to know exactly how long you have to exercise your options, as well. That should be in the option agreement. But all these other things are not in the documentation you're going to be given.
Understood.
Most likely, you have to separately ask for them. But the preferred stack, shares outstanding, price per share in last round, all these things are really important. A lot of employees end up, accepting a deal, not even knowing what percent of the company they're going to be given. They just know that they're getting X number of shares, which is meaningless. You really don't know. A company could have 1,000,000,000,000 shares, or they could have 1,000 shares. You would know. If you get 10 shares of stock, that could be great, or it could be nothing, or small. So I think that's the biggest thing. I mean, I think in a perfect world, you would also want some, like, governing body or regulator to kind of, require that, hey, you have to disclose these things when you're hiring somebody who's getting option compensation. At the same time, I also am somewhat skeptical that you know governing bodies and regulatory agencies get those things right. They typically don't. They typically get them wrong. And so, I don't think that's probably a solution. I think education is a much
Understood.
better path.
Understood. Out of those three topics that you mentioned, the three issues or three kind of flaws, one is miscommunication. So we talked about the second one is about when the employee leaves and then they have to produce a lot of capital, or there's a very restricted time frame of maybe 60 days or maybe 3 months or so on, which might not be sufficient in a lot of cases. So as I understand, there are now, at least in the US, platforms which can help finance those, right? So that's kind of one solution. If you want to talk about that, please do. And the second is, like, how would you want to solve for that, this specific topic of employee leaving and being asked to
Right.
produce the capital?
Yeah. So, first of all, different employees have this set up differently. There's no requirement, as far as I'm concerned. I think 10 years is your max. I think that there is, like, an outside date that is also tax oriented for how long an option can last. But ignore that's a long time. Ignore that for now. The companies can choose how to do this. Now, founders are advised how they should do it by their lawyers and by their investors. And so, curiously, they all end up looking the exact same. Um, yeah, most of the time you have 90 days to exercise. Particularly if you stay at a company for a long time and that company's doing well, that price of exercising those shares is going to get pretty big. And so, one thing is if you're an employee and you're kind of making option compensation, you need to start saving money to eventually exercise those shares. That's the first thing, and nobody ever talks about that, but you should. If you want your shares to be valuable, if you want your equity compensation to actually be real, you need to have some cash sitting around. That would be the best solution. The second best solution, and I'll have the actual best solution in a second, but we'll get to it. You're right. There are platforms that can finance this, but I would not say that those are perfect. I think that some of the interest rates can be high, and depending on what something looks like for you, that they can destroy a lot of the value. Not every company is financed. I think that there definitely are restrictions, like the 50 most popular companies in the
True.
U.S. Will
True.
be on those platforms. The 1,000 other ones won't. And there's multiple providers, and I don't know all the details for how they work, but doesn't cover everything. And you also lose something by using it. It's not a free deal. That provider is doing it because they think that they can benefit from it, and so you're going to give something up by using that. It'd be better to save the money, put it in a savings account that earns interest, and then when you need it, be able to use it. That would be a better outcome for that employee. But there's that. And then sometimes investors or the company theoretically will actually offer to buy your options before you even have to exercise them.
True.
That doesn't happen very often. It happens at the very large companies that are doing very well and are very well known, which people in that group are usually okay anyway. That's by the time you get to that point, there's many more options. It's kind of on the way there. There's a lot fewer. So I think that the financing platforms help. I don't think that they solve the issue, and they come at a cost for the employee because that person's more sophisticated than you probably are, and because that's what they do for a living. They do these deals. But in my opinion, the best thing to do would be for companies to just by policy extend their exercise period. I think that the companies should give people years to exercise. I think they shouldn't do the 30 to 90 days.
Okay.
I think it kind of structurally unfair given how it works in reality. I think that my point of view is that if you gave people an infinite amount of time to exercise, that would actually be, or 10 years to exercise, that would be better because then you don't have to worry about voting rights and things like that because it is an option. And also it reflects closer to what everybody thinks the deal is anyway. People join a company not expecting to have to invest in the company, but that's what actually it is. They expect this thing that they get to eventually be worth cash, not that they're going to have to put cash in. And so if you're able to hold those options until a liquidity event or until somebody can show up and buy them, that's a lot better result for the employee. And it's not tremendously different for the company. It's true the company will forego some of the strike price that the employee would have to use to buy the shares, but that doesn't ever end up really being significant for the company. It's a very good thing for the employees, and it doesn't really come at a tremendous cost for the company. Something I'll talk about probably in a second when we get to the third one is there are other ways that this can be done entirely. It is possible for companies just to give their employees stock.
Okay. What do you
Forget the
mean by that?
option. Just to not give an option, to give the stock itself, or to give an RSU or some other security that is not a stock option that needs to be exercised. We maybe when we get to the third one, I can talk about that some more because I think it has there's tax implications, and that's actually the thing that the tax rules really changed.
Okay, so let's go to the third one, which is the first one that you mentioned about the taxes, right? So you suggested, maybe it was in this post or some other post, but you suggested granting common stock with taxes gross up. of
Yes.
companies paying taxes for them is a better model. So what
Yes.
would it take the startups to actually adopt that to be there?
Yeah. So this option, which I think is more fair, and I think it's kind of more intuitive, it's more transparent. It is the thing that everybody thinks they're actually getting when people accept options, but they're not getting because it's an option. Is the ability for a company to offer you shares in a company, which is actually exactly what founders get. So when a founder starts a company, they get they get common stock in the company. They don't get an option. They get common stock. And when a company is started, that's much simpler. You have an election under the tax code called 83B that every founder files to avoid having to avoid any tax implications. That wouldn't work under the existing rules for employees. But what would work is and this would be not super hard for a young company. What would work is for the company to give that employee common shares and then pay a small amount in kind of the tax income or taxable income or no tax payable, sorry, the taxes that employee would eventually owe on that amount, and you would just gross that up to where the employee does not face a liability from those shares. This happens. There are companies that do this. I've seen it. It is not very common in the venture capital universe. It's more common outside of the venture capital universe with established companies or companies that are starting up in different industries that are not backed by venture capital. It's much more common.
Okay.
So I think that more companies should explore it. I think it is possible that you maybe it's more expensive for the company because you're having to shell out cash to pay the taxes, but it's better for the employee because they don't have to shell out the cash eventually, and the employee is actually receiving the value of a share. You're not having to eventually pay the value of the share, that whereas under the current system the employee only benefits, the option's only worth anything if the price per share goes up. If you give them stock, they're receiving compensation for the value of that stock, 100% of it. It's a very different deal. And so in reality, you would probably give less. You would give fewer shares. You would give lower notional value of that equity, but the actual value of that compensation would be significantly bigger because it would never have to be exercised. And it would also benefit from the upside because if the value of the common stock per share goes up, they benefit from that stock per share. I believe that this should be done more often. There's probably other things you would need to do, like you might need voting agreements and things like that, because it does create complications if all of your employees are voting at the shareholder meeting, and
Yep.
that's
True.
there's just governance things that's potentially an issue. But I think that um, that it would kind of fix a lot of these other issues, may create some minor issues, but I think more companies should look at it.
Okay. So nothing is like picture perfect, right? There's always ups and downs somewhere. So you mentioned it's in another industry. Is it in private equity? Like, can you give an example
I've seen it some in the banking world
in the bank? Okay.
is more common. The private equity typically has its own method of compensation. I think phantom shares are used there more commonly, which resemble options. They're in an LLC as opposed to a C corp. I think I dealt with these much earlier in my career when I was a corporate lawyer. We were always, kind of figuring out the value of these phantom shares and RSUs.
Understood.
It's I would even say, like, I think that the private equity compensation might be more sophisticated though than the venture capital. I think you typically have more sophisticated parties around the table because private equity happens when a company's being purchased. And the executive team that's setting all of this compensation, they have lawyers negotiating this stuff with them. And so it probably ends up being a little more arm's length and fair. Probably. I don't do that anymore, so I don't know. But I think also fewer employees of private equity backed companies get options and get that equity in the first place,
That's true.
which, I think whether that's a good thing really is, there's no answer to that because
There's not.
if the company is more likely to succeed and they're paid higher, that's they maybe are getting a good deal. It really depends on each individual case.
Okay. So very quickly, within this startup ecosystem, the way you mentioned about using the tax and paying up the tax crossed up and so on, do you see it happening within the ecosystem by any company, or is it just like a more of a theoretical thing, theoretical answer from your side?
Yeah, it's theoretical. Now, there's something that later stage companies do, where they will grant RSUs to employees, which are effectively common shares. Perhaps that's something that could be explored. That is a model that works. I think it resembles the model of kind of just granting people equity. Uh,
Understood.
and there are, I do believe that there's a tax gross up component of that, and it's something I haven't dealt with quite as much. We never implemented any of those, but that's probably the best. I think it's a little more expensive it's more complicated for the companies to administer. And I think that's one of the reasons it doesn't really exist for earlier stage companies. So I haven't seen the common shares approach being utilized. There is the RSU approach for later stage companies that's used typically before you start doing it kind of in a pre IPO standpoint. That's where it becomes particularly common.
Okay, because you mentioned pre-IPO and you have also mentioned within your post Stripe and this windsurf situation. Tell us about the lessons. What was the situation around these two examples that you wanted to highlight on this employee equity topic? And what do you want other companies to take it as a takeaway, for example?
Yeah. Yeah, so I've never I was not investor or employee or anything with Stripe or Windsurf, so I don't know, every detail about them. Stripe, I feel like the Stripe has really tried to do the right thing. I feel like for its employees, there have been issues that are created by the tax regulation in the U.S. I mentioned that 10-year limit a few like at the very beginning of this discussion. They ran into that issue because the company has been around more than 10 years, and kind of just all of the options for a lot of those people just timed out. And so there was a to keep that compensation, there had to be basically a liquidity event for those employees. And so my understanding is what Stripe did is it went out and it basically on the employee's behalf raised money to effectuate that. That's great. I think they did the right thing. They really, tried to they went beyond what they were required to do the right thing for the employees so that their compensation didn't just expire, which would have been very unfortunate for those employees that had produced a lot of value and grown with the company. So, so Stripe did the right thing. It does illustrate that the regulations just create a mess. They create problems the way that they currently are set up. I'm no, I don't know, it's far beyond my capability to change how the IRS regulates anything. That's hard. So I'd leave that for somebody else. But the rules create problems, and Stripe is an example of problems being created. With Windsurf, similarly, I was not an investor there. I'm not involved with the company. It is something where there's been a lot of discussion about it, and it's been confusing. But I will say, I personally don't think it was the right thing was done. I think what ended up happening is the founder of the company was able to cut a deal in which they really benefited from an acquisition. The acquisition of the company, which I think on the surface was structured so that antitrust rules were not triggered in the same way as they would have been through a typical merger. And so the founder received a huge benefit and now is an employee, the larger company. But the investors were largely paid back in full, I believe. But the employees were kind of left in the lurch. They were left in a position that was significantly less desirable than what the founder was able to do. I don't think that's right. I think while there are occasions where kind of a founder will, because they're going to continue working with the company and running the company, it's not that unusual for them to get a better deal than the employees, but they usually, and there may be good reasons for that sometimes, but gap should not be nearly as vast as it was in that case. It really kind of goes against the entire spirit of equity compensation, which is I will join a company, I will create a lot of value, and if the company succeeds, I succeed as an employee. That didn't happen in that case. The employees got something, but they got something much more modest than the outcome for the what the company was. I know the legal structure makes this all very confusing, but I think that I don't know the solution. Anytime you get highly paid lawyers and lots of money moving around, there's the opportunity for different groups to strike a deal that's beneficial to them. That's the reality. That's the any M&A is has no shortage of let's call them differential outcomes. When somebody's getting highly paid. So this is not new, but it's particularly unfair because the people who really don't have a seat at the table when these deals are being struck are the employees, and they're the ones who got screwed. Um, and so I would like to see that the world create new different norms, different. Again, I don't believe a lot in regulation fixing these things, but maybe regulations, maybe the Delaware Court of Chancery, which creates all the rules for corporate laws, maybe they be able to speak to this in some way and discourage it, because it's if that becomes the norm for venture backed startups, that's unfortunate because then you're not honoring the promise that you gave to those employees that they would you know benefit they would own a share of the company, and they would be paid for that share if there
Understood.
was a liquidity event.
Understood. I had recently Willie Ilchev from Category Ventures, and he's coming from. So I had podcast with him just on windsurf, and he had written a beautiful article titled "The Blitz Hire Acquisition," and he explained all around this specific topic, whether it would continue or not. And his background is basically M&A. So I get you, Andrew. Thank you so much for joining in with those thoughts around Stripe and windsurf. I mean, we captured the whole chain of those three issues that you mentioned, right? The one is the tax issue, and it could be the solution could be the common stock variation that you mentioned. The second is employees when they leave, for example, they have to bring a lot of capital, and the third one is around communication towards understanding on what employee equity actually is and how it should be structured and what founders need to do. And obviously the onus lies on the employees themselves to understand what they're getting into, right? So thank you so much for providing so many details around this topic. It was fun.
Absolutely. I really this is something I just enjoy talking about, and it ends up being a meaningful thing for a lot of people. So any contribution I can make to people making better decisions and negotiating better for themselves, is something I love to do.
Awesome. Andrew, thanks for joining in.